Um, Most of you may be wondering why NAP Kisan? Why NAP Kisan has been invited to this forum for sharing their experience. We are here. We are, as I mentioned earlier, we are a part of NABARD. NABARD is a major shareholder of NAP Kisan. Along with NABARD, Government of Tamil Nadu, and all the other major banks, Indian Bank, Canara Bank, Indian Overseas Bank, TMB, a host of other banks are also shareholders in our organization. So basically, we are a blend of financial institution, development financial institution like NABARD, Government of Tamil Nadu, government organization, and most of the PSU banks. They are all shareholders. So we get the best of both the worlds. So we try to take this advantage. We derive this benefit. We derive out of the experience of all these our shareholders and put into practice, be it in our credit product or in the way we do our business and the way we develop new ideas and implement all these things. We derive from our shareholders. This is the experience we get because of our parentage. So as I mentioned earlier, as of now, we are the largest lender in the FPO ecosystem in terms of outstanding FPO loans. We have funded close to 1,600 FPOs so far across the country. We have our footprints in 22 states in the country regarding FPO funding. And as of now, our interest rates are highly competitive, and we try to keep it as low as possible within the constraints whatever is available. Still, we maintain the interest rate as the lowest possible level, which will get with the benefit will flow to the FPOs. This one, and we provide mostly collateral-free loans. The collateral-free loans we are in a position to provide because of our convergence initiatives and our tie-ups with different credit guarantee schemes. So that's how we are in a position to provide collateral-free loans. As I mentioned, we collaborate with various stakeholders, be it credit guarantee providing institutions, various state governments. We are administering the programs of Government of Tamil Nadu. There are 3 programs: mezzanine capital assistance, credit guarantee scheme, and also the inter-subvention scheme. And also we have a tie-up with the Government of Odisha, and we are implementing their credit guarantee scheme also. So as I mentioned earlier, we operate on a pan-India basis. As of now, we have footprints in 22 states, and maybe this year we'll open our account in Jammu and Kashmir and also in Manipur. The proposals are on. Hopefully, we'll cover those 2 states also. So, friends, Mr. Srinivas or Mr. Dr. Kiran, when they mentioned, they used the word credit readiness and credit worthiness. I'm very happy to hear such words because that is the need of the hour. So what I'm planning to do now is I'll slightly digress from my topic, because the topic given to me was the credit facilities available to the FPO. I'll come to that couple of slides later. As I could see, a lot of producer organization promoting institutions, POPs and CBBOs as a participant. So we would like to highlight few issues which they should take care to make the FPO, the credit facilitation, a very a smooth exercise. So wherever we speak, whichever forum I get, I always insist on these 2 things, credit worthiness and credit readiness, before getting into the main topic. Because these 2 things are taken care of, then credit facilitation will be a very easy journey, smooth journey. So I take this small liberty to talk to the forum regarding this credit worthiness first. First one is, what is credit worthiness? Any lending institution will touch on lending borrowing entity only if they are credit worthy. Credit worthy means from a FPO's context, they should have a equity base, proper equity base, in the sense minimum 2 lakhs. Different entities will prescribe a different equity based structure. They should have a decent equity mobilization, that is a mobilization of share capital from their shareholders. We have seen in many cases there are certain FPOs in Madhya Pradesh, which is a front runner of FPO initiatives in the country. There are good old FPOs, maybe 15-16 years old FPO, still their equity base is very low, though they are doing wonderful business, a very huge shareholder base of 6,000, 7,000 members. If you see their share capital per member share capital will be close to the tune of 200, 250, 300 rupees. So our request is as a POPI or as a CBBO who are planning or who are doing this FPO formation exercise at this point in time, kindly at the beginning, in the initial stage itself, when you do the concept seeding exercise, just you have to hammer on the importance of this equity base collection of share capital. In initial stage itself, if you have 1,000 members, try to collect at least 1,000 rupees as a share capital, so that in no time the FPO will be ready for accessing credit. And second thing is statutory compliances. Definitely, if a FPO has to be credit worthy, they need to put in place all their systems and procedures, and their statutory compliances should be there. Either if they are former producer companies registered under Companies Act, they should submit their returns in time. They should maintain the details. If they are GST compliant, they have to file the GST returns and all the associated statutory things which they are supposed to take up. They should do it. And then any banker or any financing institution will expect a reasonable profitability from the FPOs. There are different schools of thoughts regarding the profitability angle from a FPO's point of view, because the basic concept all of you may be knowing, the profitability of the profit generated by the FPO should ultimately lie in the hands of the shareholders. That is, the farmers. The ultimate farmers should reap the benefit. The company should make a minimum profit. That is how the FPO concept is being looked into. This is well taken, but still, as you are going to access credit sooner or later, definitely slide the profitability angle should come into place. Profitability in the sense, the profit should be shown in the books of the FPOs also. Not all the profit or no, everything has to be passed on to the farmer members. At least 20-25% of the profit, it should be visible in the books of the FPO also, so that the credit purveying institution will derive comfort regarding the transactions of the FPO, and going forward, they'll be in a position to take higher exposure also. And the fourth one is the turnover should be commensurate with available working funds. Working funds means they have the share capital base, they have some retained earnings based on previous year's profit, whatever they have made, and whatever borrowings they make, either from the directors. Most of the FPOs, they take hand loan from the directors, sort of informal borrowing, or they access funds from the financial institutions. So all these borrowings to put together, whatever working funds they have at their disposal, the turnover should be commensurate with that working funds. We happen to see many FPOs. For some, they have garnered a lot of working funds through their borrowings, through their this one. But when you see their turnover, it's absolutely low. There is no correlation between the funds available with them and the turnover thing. We do understand because of the COVID related impact, these 2 years, there was a lot of restrictions on the part of the FPOs to expand their business, and they were treading cautiously. Those field level realities, yes, if it is there, it can be taken care of. But if there are no basis for a lesser turnover, then as a financial institution, this becomes a dampener. So whatever working funds they have, they need to have a turnover commensurate with the working funds. So if these 3-4 points are taken care of, then we can safely say that the FPO is credit worthy. So the bankers can lend, means they are ready for the bankers can lend to them. So most of the FPOs, they qualify on this count, credit worthiness. Most of the FPOs are qualifying, absolutely no doubt. So what is the other important aspect a banker or financier will look into? That is next thing, that is credit readiness. So what I mean by credit readiness, the compliance related issues, though they may be credit worthy, the compliance, say for example, if it is a company, they should file their returns regularly. At least they should cultivate the habit of filing. Initial stages, definitely you need a lot of hand holding in terms of filing the returns. The chartered accountants or whoever is running the show, definitely they need to seek the help of chartered accountants to do it. But sooner or the later, they should be accustomed to this practice of complying with the statutory requirements. Many of the FPOs they are not doing it, and they end up paying hefty fines, because of that. If they are registered as a cooperative society, so whatever returns they have to file to register of cooperative societies, they should be in a position to file it as per the required periodicity. So as a financing institution, we'll be focusing more on these aspects also. So right from the formation stage, I request the poppies who are here to drill these aspects to the FPOs at the formation stage itself, because it's sometimes it becomes very difficult to drill these things when the FPO is some 2 to 3 years old or 4 years old. They won't be easily amenable to these sort of new set of changes. So right from the beginning, if these things are instilled, then they know that within a span of 6 months or 1 year, they will be credit ready, and the process will be smooth. The second aspect which I would like to highlight is bookkeeping. So being a rural centric entity, a deep rural entity, definitely we understand we cannot expect a very robust bookkeeping mechanism. Still the transactions are done through cheats, buying, selling, all those things are happening, but they have to get into this system of proper bookkeeping. They should maintain records, registers, which is available for everyone to see, both in terms of for the transparency angle also, and also from the angle of the financing institution. It will give a lot of comfort both to the shareholders, directors, and also to the financing institution. So right from the beginning, proper training inputs should be given for bookkeeping aspects also. Some of the FPOs, they have started maintaining in Tally their accounts in spreadsheets. It's fine. Right from the beginning, if you can try to introduce these tools, they get used to it, and there will be no looking back from that. And a lot of now fintech players are also available in the market, who are giving very ready-made, custom designed the solutions for the FPOs also, for maintenance of accounts, and also to capture their transactions. Those tools and those softwares and packages are also available in the market. So these things are to be started very early in the life of an FPO. Cash flow visibility. So this has a relation to what I have said earlier. Cash flow visibility, by which what I mean is the FPO in the rural sector, the farmers are used to dealing in cash. That is the type of operations they are very comfortable with. So the FPOs are also extending the same thing. They do a lot of cash transactions with their sellers, or when they do procure the commodities from the farmers, and when they sell. This has to be a bank-led transaction. Slowly they should move towards a bank-led transaction. They should use the banking channels, so that as a lender we have the cash flow visibility. Though the FPO can claim this is the turnover what we have done, if it is not reflected in the bank account statements, then it will be very difficult for the banker to get convinced. So whatever transactions they do, since they are an organization, a full-fledged registered statutory organization, they need to route all their transactions through bank accounts. This is a very important aspect. This instills discipline in the FPOs also, rather than dealing in cash. So timely audit, this is very important, because most of the FPOs, if the time limit is given as 30th September, till last minute, their books are not audited. Some of them overshoot the time also. So this comes in the way when we look into the governance aspects of the FPOs. So please audit your book on a timely manner. Your bookkeeping definitely helps in quicker auditing, because we have interacted with many auditors also. Their version is, sir, those books which they have submitted to us are in very kacha form. We are not comfortable. Even if you ask details, it's not forthcoming from the FPOs. These are all some of the reasons we hear from the auditors regarding the delay in which the delay that is happening from the auditing angle. So if right from the beginning, if they are having a habit of maintaining a good records, bills, receipts, then the auditing process will be very smooth. So they need not even wait till 30th September for completing the audit and completing the AGM as per the statutory requirement. They can very well do it in first quarter itself. Having said that, we have come across several FPOs who have completed, we have audited their books by 30th June itself. So such FPOs are also there, very, very quick in getting their books audited. That is primarily because of the way they function. And then the very, very important thing, composition of board of directors. The initial stage of formation itself, the producer organization, promoting institutions, or the key persons driving the FPO initiative, they should focus on having the board of directors who are impeccable, who have impeccable credit record. So what is happening is, most of the FPOs we find, if they have 5 board BODs, all the 5 are close family relatives. Most of them are blood relations. This is what is happening. So kindly let us not make it as a family affair, or else the entire concept or entire the grain of FPO gets defeated. So right from the beginning, when the board of directors are appointed, let them represent the various strata of the FPO, various villages, various clusters. They should good representation, progressive farmers, all those people. So kindly don't allow the relatives to get into the scheme of things. So this gives a lot of discomfort when we appraise a project. When you see a lot of close relatives, father, son, daughter-in-law, mother-in-law, almost all 5 are very, very close relatives. This should be avoided in the interest of the FPO, and also in the interest of the sustainability of the organization also, and in terms of transparency of operations. The second thing is, the board of directors, as far as possible, there should not be any defaulters. Why we say this is, if the director has already defaulted, then the way he look at the credit availment, and the way they deal with their financing entity will be totally different. Being a rural area, there will be many reasons for the default. Say, for example, the common reasons which we hear is, they were waiting for the loan waiver from the government, so that's why they have not paid their KCC loans. This is a common refrain we get even from some of the very good FPOs, who the directors are very active, but still their credit bureau records are not up to the mark. So at the time of inducting directors, kindly the poppies, please pay heed to this request of ours. Let them be a default free with the directors with a good credit history, so that they can drive the FPO operations in a similar manner. And last but not the least, it's a governance part. The governance part, it encompasses all the 5 points which I have dealt earlier. So it relates to having a proper board of directors, having a clean book, doing banking transactions, having meetings, statutory meetings, board meetings, different committee meetings, annual general meeting, all those things taking place in time and working in a transparent manner. These things, if these things are told at the initial stage itself, the FPOs, the FPO functionaries, and the FPO's key management personnel, they'll be tuned to these aspects. And when they start doing it, it becomes a routine affair for them. If these things are told after 2 years or 3 years, definitely there'll be a lot of resistance from their side, and the implementation on all these counts will be a big challenge. So these 2 slides I have taken liberty, so because I wanted to place a request among all the poppies to take care of these aspects. So wherever I speak, I do make a point to mention these 2 aspects, so that at least if 20 to 30% of the poppies take care of this when they form the FPOs, it will be a very smooth exercise. See, as per our experience, when NABARD started forming the FPOs under Produce Fund and PODF funds, those FPOs, it took almost 3 years to graduate them to a level where they can avail credit. So our endeavor is, now this 10,000 FPO scheme is in the offing. So based on the learnings based on the learnings and past experience, we should be in a position to onboard an FPO within 6 months of registration. That is our idea, and that is that is the direction in which we are working. So that will be possible only if these aspects are taken care of by the poppies. So they will be at the early stage itself, they'll be ready to access credit. So in a nutshell, this is how I classify whatever I have spoken. There's a slight subtle difference between credit worthiness and credit readiness. This is what is captured. So this is a way forward. As I mentioned, right from the beginning, infuse commercial orientation through the FPOs, focus on governance, focus on market linkages. As far as early as possible, try to identify the market aggregators, good traders, processing unit, so that they'll be in a position to understand their requirement at the early stage itself, be it in terms of quality, quantity, and timeliness of supply. It will be a smooth sailing process. And one more request, avoid getting trapped in capital intensive infrastructure facilities during the early stage. This wherever possible, being one of the important stakeholders in the FPO ecosystem, some of the state governments also consult us during their consultative process when they launch their schemes. We always say, see, just keep the formative FPOs which are in their formative stages away from this infrastructure subsidies, at least for a year. Because if just because the subsidies are available, capital subsidies are available, if they are going for that subsidy, most of the state governments, they give 80%, 70% subsidy, and the rest 30% as bank loan. They end up creating huge infrastructure, but they won't be eligible to get adequate working capital because of their low equity base, their vintage, that is the age of the FPO, and all other aspects. So they will end up having an infrastructure without working capital loan, without adequate, I can say, without adequate working capital loan. The type of infrastructure they create, the working capital loan required will be huge, which as a financier, as a financing institution, won't be comfortable to extend given the vintage of the FPC and their share capital base. So once they grow to a certain level, definitely they would have improved their equity base, and then they have improved their governance aspects. So all those rough edges would have been smoothened. So it will be very easy to extend a higher quantum of credit, matching with the requirement of the processing unit or a infrastructure facility which they have put up. So it won't be underutilized. So initial stages FPO, at least till 1 year, though the grant infrastructure grant facilities are available, as a producer organization promoting institution, please guide them properly. They can avail next year. The schemes are going to be there because every year the government of India and all the state governments are also fine-tuning their efforts to suit the requirements of the FPOs. Definitely they'll be in a position to access those funds also, grant-based assistance also. Kindly wait, let them settle down, let the governance issues gets ironed out, all their rough edges let it be smoothened. Then definitely once they reach a platform, they are ready to take off. Definitely all this infrastructure funding will make sense. And always keep an eye on developing good credit history right from the beginning, be it a borrowing from the board of directors or a small ticket borrowing from any financial institution, maybe a 5 lakh loan they can take, but they should make efforts to pay that loan on time. This makes a lot of difference because even established FPOs also, because of various things, maybe sometimes the financing institutions also falter when they fix the repayment schedule. I do agree. Sometimes it may not be in tune with the reality, the harvesting period or the credit period which the FPO offers to their buyers. So because of that, there will be definitely a mismatch between the repayment period factored in the loan and the actual proceeds they'll be getting from the ground level. So these things do happen. But as a financing institution, we are also learning, and we are all taking care of this aspect by giving an extended repayment period at the time of sanction itself. So the FPOs, they should be very careful in repaying the whatever the repayment commitments within the due date. There are certain cases where the FPO, they have taken loan, but in anticipation of higher price realization, they are still holding on to their goods and they are not in a position to repay us. So we have to take a stop loss policy here. The margin, they may be anticipating some 20% margin or 15% margin, but it's not happening within a span of whatever the expected period of 3 months or 4 months of storage. Then the FPOs should be guided to cut their loss, sell off their produce, and pay back their loan. Even if they reduce the profit, because once the credit history is damaged, it will be very difficult for them to access the loans for their future requirements. It will be the FPOs will be possibility is that the FPO will be permanently doomed to get a credit. So you have to live another day. Maybe next year, definitely the things will be better. So I'm not saying you should dispose of the product, your producers on a loss basis. If things are not working out 3 months, 4 months after the harvest also, and if there is a liability to take care of, yes, definitely you liquidate the stock to the extent possible and clear the liability so that immediately you will be eligible for credit for your next round of operations, because it's an agriculture operation. Day in and day out, you are going to do the same operations. Next year, it will be a very bumper crop. It will be a profitable year for you. So during that year, when the huge procurement opportunities available, if you are deprived of credit because of your past credit history, this will be coming in the way of the sustainability of the FPO. The FPO may wilt at the second year itself. So this sort of slight orientation towards taking care of the repayment aspects has to be ingrained in the FPO right from the beginning itself. So I'm coming to the main part of my presentation. What are all the credit products which NAB Kisan is offering? What are our eligibility norms? I'll just quickly run through this. See, we are ready to give credit to nascent FPOs also, and we have been giving it for the past 4-5 years. So minimum 6 months of incorporation is enough for us. That is from the date of application to date of incorporation. It should have a cost minimum 6 months should be there, and they need one audited balance sheet. Audited balance sheet, by which what we mean is, say for example, if they have incorporated in the month of say July or August, so they need an audited statement, means by 31st March that financial year would have ended. So this 78 months audited statements we require. And based on the ground level realities and the recent trend, we have made a slight flexibility we have brought in our policy for the FPOs formed under this 10,000 FPO schemes of Government of India. We don't insist on an audited statement. Even if a 6 months old FPO, if they have a CA certified provisional statements, we are ready to extend credit for those FPOs also. So this is a flexibility we have brought in our policy to accommodate the FPOs which are being formed now. And minimum 2 lakh share capital should be there with a positive net worth. And they should not have defaulted to any other organization in the past. That's why I was again and again insisting on the importance of having a good credit history. Any financier, they pay a lot of attention to this aspect. So kindly make it a point, be at the time of preparation of business plan, make it as realistic as possible, so that you don't become over ambitious getting by having a over ambitious business plan which entail a huge credit, and if you're not able to meet the repayment commitments, then your future is at stake. And then they should be, whatever business they do, they should have all their legal clearances, be it a GST number, TIN number, whatever licenses inputs, if they are doing as per their state government regulations, they need to have the licenses in place. If FPOs are in the initial stage of formation stage, and if they have applied for licenses on a case-to-case basis, we are ready to give that relaxation also based on their acknowledgement received for having submitted the papers for obtaining the license. It's purely on a case-to-case basis. We do that also. And there should be a regular CEO in place. It should not be a part-time CEO. The CEO should be a regular CEO. And I think all of you may be knowing, kindly pay an attention to do this. The CEO should not be a member of the FPO. As per the Producer Companies Act, a CEO should not be a member of the FPO. In many FPOs, we are seeing a CEO who is a member of the FPO. So kindly take care of this aspect also, because it's going against the Companies Act. So at the time of formation, when you're taking an FPO, see to that he is not a member of an FPO. And business plan, we need to have at least 1 year. Though the business plan, the word sounds very big. All we need is a very brief plan, which clearly indicates which month, how much procurement they are going to do, what is the quantum, what is the unit cost, what is the total amount required, and what is their terms of sales, whether credit sales or cash sales. If it's a credit sale, when they are going to when they will be getting the proceeds. So these basic things, if they are captured, it's good to go. We are okay with it. We don't need a very hard bound business plan with 40-50 pages. That is not expected from the FPO. A brief detail regarding their locality, cluster, the cropping area, along with what I mentioned, business related aspects, 1 or 2 pages will suffice. And we have our internal rating mechanism, that they have to, the FPO has to pass through that internal rating scale. It should be rated A, B, or C category. As I mentioned earlier, we have taken our one more category, C plus category. We have recently inserted this year to take care of the requirements of the nascent FPOs or the FPOs which are just formed. As I mentioned earlier, we are ready to extend credit for a 6 months old FPO also, provided they fall under this C plus category. Where C plus category, in the sense, what we mean is there are certain norms we have relaxed so that these FPOs will be eligible. Otherwise, if you follow the strict norms, the FPO which is 4 years, 5 years old, the category, the different aspects which we see for our rating, and FPO which is 6 months old or 1 year old FPO may not be able to cater to. So after understanding this requirement, we have modified our rating scales to accommodate this new FPOs also. So we'll be in a position to take care of that. And they should comply with all the KYC norms, anti-money laundering norms, whatever it is there. It's just we take the basic documents, KYC documents they have to submit. And we run a CRIF, the credit information check on all the directors and also the company. To know their credit history also. So basically, if they qualify under all these parameters, they are good to go. They can access credit from NAPKISAN. So as I mentioned earlier, we give different products based on the requirement of. We offer different products based on the requirement of the FU. However, the most popular product so far is working capital loan. Almost 90% I can say of our clients, they want working capital only, and some of them based on their vintage and if based on their improved turnover, they are slowly graduating for availing term loans for creation of infrastructure purposes. So working capital, as you know, it's basically for procurement operations and also for trading operations. The interest rate is very competitive. I'll come to the interest rate at the later part of our presentation. The maximum we give a 18 months product in terms of working capital. We have built in some inbuilt flexibility also while giving the working capital. Now we have come out with a product wherein the FPO can borrow at least multiple times within the sanction limit. If they have a sanction limit of 50 lakhs, and if they have taken this, if we have disbursed that 50 lakhs, they can, as and when they get surplus within the 18 months period, they can repay. And again, based on their requirement, they can take back that amount. They can rotate that amount. That of flexibility we have brought in. So we call it as a flexible working capital loan, wherein the FPO will be in a position to rotate it 5 times within the sanction limit. Most of the FPOs, it's gaining popularity, and this product we have brought in based on the demands from the FPO only. And term loans, it's any pure vanilla term loan for any of the infrastructure purpose, be it construction of godowns, buying farm machineries, having a custom hiring center. For all the other purpose, we can extend up to 5 to 7 years term loans. And we are one of the eligible lending institutions for lending under agri infrastructure fund. In fact, we are one of the first NBFCs to be onboarded by Government of India for lending under agri infrastructure fund, wherein the FPO get a concessional rate of interest. They can get the ultimate landing rate will be close to 6%. They can get the loans at 6% for their term loan purpose, with a 3% subvention available from Government of India. So NAPKISAN loans, if for eligible purposes, if an FPO is availing, they are eligible for getting this interest subvention under agri infrastructure fund. And another important product is pledge loan, that is the storage loans against warehouse receipts, what they normally call. Here we lend against electronic negotiable warehouse receipts, wherein the producers are pledged in WDRA accredited warehouses. Electronic negotiable warehouse receipts are generated. By pledging those electronic warehouse receipts, we'll be in a position to extend loan. So different products have a different storage shelf life. According to their shelf life, the repayment facility will be fixed. so some of the FPOs have started taking this facility from us, and I can tell you they have a very a steep benefit they have got because of the price realization. I request the organizers to arrange a separate training program, maybe with the NERL or WDRA, regarding this electronic warehouse, negotiable warehouse receipt based financing also, because it's the process is very easy and very simple. The FPOs can take a benefit out of it, because as you practically, if you look at it, the farmers are getting enough loans for purchasing of inputs through KCC. It's already taken care of. What is lacking in a scheme of things is the post-harvest loans. Post-harvest loans are very hard to come by because of various reasons. So this pledge loan facility through ENWR will bridge that gap also. The farmers collectively, all their farmers' requirement, the FPOs can take care of by availing the post-harvest loans through the ENWR. So this will be a win-win situation for the entire credit purveying system also, and for the FPOs, and also for the farmers. So basically, we classify the FPOs as a startup FPO, which are just up to 2 years. Matured FPOs who have aged up to 2 years, but they have a very good turnover. They have crossed the turnover of 25 lakhs, and high potential FPOs which are more than 2 years of age and a turnover in excess of 1 crore. So based on that, we fix our credit eligibility. Startup FPOs also, even the beginners, as I mentioned, we go up to 5 times of their net worth. When they graduate to this phase, we lend up to 10 times of their net worth. High potential FPOs, we go up to 20 times of their net worth. So we have kept adequate, very, very liberal facility in terms of multiplier of net worth for funding these FPOs. So we require at least 15% of their margin for all the FPOs, meaning thereby 85% of the business plans requirement will be taken care of by NAPKISAN's loan. So the loan process, it's again a simplified process. Once you submit the loan, we have our business development managers across the states, and we have an online system of submission of loans also. Once you talk to our business manager over phone, he will guide you regarding how to submit the application through online. So once the application is submitted online, we have a process of having just a brief and breezy preliminary scrutiny appraisal process, wherein we check the eligibility of the FPOs, if everything is in order, whatever requirement, and then we'll convey the FPO. You are good to go. You are ready for our credit assignment. So our person will go there for a field appraisal, and then we prepare a memorandum and get sanctioned. Now we are in the process of completely automating the entire gamut of sanctioning process to reduce the turnaround time. Here I request the poppies to guide the FPOs in keeping the statutory documents ready when they approach any financial institution, because many a times even the KYC documents, to parting with the KYC documents of the directors, the FPOs are taking quite a bit of time. Because of that, the initial stage itself, our process gets delayed. And when the season is approaching, the FPOs feel the heat, and they feel that the delays on the part of us. So if they can keep all those requisite documents ready, because we are not asking any documents which are not accessible to the FPOs. All those documents we require are all with the FPOs. Only thing is they should make it readily available in a timely manner. The rest of the things can be taken care of. So processing fee also, what we are planning is we are gradually reducing the processing fee as they come to us for a repeat second time or third time. Our processing fee will also gets reduced substantially. This we have done to reduce the burden of the FPO. And as I mentioned earlier during my presentation, we do have a rating scale. These are all some of the aspects we look into while we rate an FPO: the age, experience, governance mechanism, management, share capital, financial aspects, all those things. So these are the key criteria we look for when we rate an FPO. So based on the primary sources data available and discussion with the FPO, certain aspects are captured. And based on the secondary data, based on your financials, we look into certain aspects, and our credit rating is arrived at. Based on the credit rating, our interest rates are fixed. Our interest rates are directly proportional to the credit rating. So we make a slight difference between a good rated entity and average rated entity to offer them a better rate of interest. So as I mentioned earlier, it is as a NAPKISAN, a subsidiary of NABARD, we have a fiduciary role to play with regard to the FPO ecosystem. So we do give need-based grant assistance. Now what we are planning is instead of giving the grant directly to the FPOs, we are planning to support them through capacity building initiatives through proven institutions. What we are planning now is based on the cluster-based requirements of the FPOs, we will organize capacity building programs to the FPOs based on the requirements. Some of the FPOs may be requiring a hand-holding or an additional dose of capacity building initiative in terms of compliance-related aspects. Some require for bookkeeping aspects. So after understanding the needs of the FPOs, we are planning to give a need-based training that will be purely on a grant assistance basis. We'll be utilizing the grant to conduct training programs for the FPOs, the capacity building. We do organize buyer seller meets, expos, melas, and we are one of the accredited trainers in commodity city approved commodity trainees market also. So we do offer commodity derivatives related training and how to participate in the exchange platforms, all those related training also. We are accredited trainers to the FPCs. Every year we conduct those trainings in collaboration with SIGBI, in collaboration with the SEBI programs are also there, NCDX, MCX. Through those entities, we organize programs and we give inputs to our FPOs to participate in these platforms also. This all from my side. So this is basically about how we look at an FPO in terms of forwarding credit and what all the products we have from NAPKISAN side, and also how we approach the FPOs when they come to us for lending. If you have any questions, I'm free to take that. And I thought to start with, I thought it's for Telangana and Andhra. So I have mentioned the contact person details of our manager business development, both in Telangana. Shri Modu looks after Andhra Pradesh. Mr. Nagesh Siva, he looks after, he's a business development manager from Telangana. Both of them, they sit in NABARD regional office at Hyderabad. You can keep in touch with them, and I have given our number, corporate office and registered office numbers also. For any of your requirements, you are welcome to keep in touch with us. Thank you. This is a brief presentation from my side. I am ready to take the questions. Thank you.